Hi, everyone. Thank you so much for joining us with one of our final segments for Done with Divorce. We're going to be talking about our financial considerations. And today I'm joined with two of my firm's colleagues, which is the firm is Arjun Bridge Advisors, and they're also co-founders with me for the organization, the nonprofit with Divorce. I'm joined today by Diane Nolan and Cecile Holt, and they are both partners at Arjun Bridge Advisors, and as I mentioned, co-founders of the nonprofit. And they are both certified financial planners and certified divorce financial analysts. And today we'll be talking about the financial considerations as you're kind of preparing to the end of divorce. So as you're coming out of divorce, all of the things that we're going to be thinking about, they're going to be talking about today. So you can get started. Thank you.
Great. Thank you, Elise. Hi, everyone. As Elise said, my name is Cecile Holt. I am a CDFA and CFP. And so today we want to talk about the next steps once you basically have a property settlement agreement in hands. If you're joining us today, likely you do have that document, and it probably looks like a lot of paragraphs and a lot of words on a piece of paper. So our agenda today is, first, we want to talk about how do we even get started once you do have that document and you either reached an agreement with your ex or you're about to reach an agreement. And then we'll talk, so first, what are the first steps? Then Diane will walk us through the execution of the property settlement agreement. Again, all it is just a bunch of paragraphs on a piece of paper, but how do you actually make sure that the things that you agreed to are put into motion and actually happen? Then we'll talk about protection. You want to make sure that what you agreed to happens, and what happens if there's non-compliance of what's in the agreement, and how do you protect yourself? And then finally, my personal favorite of this webinar is talking about how do we move forward from here, and how do we go about putting our financial affairs into order. So without further ado, let's talk about getting started. The very first step, I think, and if you've gone through a divorce, you probably already have that support group, but building a support group around you is very important. Of course, you want to have a personal support group, friends and people who are there to support you, and maybe people who have gone through this with you, but it's also important to build your professional support group. So likely your support group right now on a professional level is probably your attorney, but you may also have a financial advisor, or CPA, and a estate attorney. And my recommendation would be identify your strengths and weaknesses, or get a good understanding of what do you know and what do you maybe not know, and where do you need help. So what Diane and I will be talking about is mostly the financial planning aspect of post-divorce. And what is financial planning is really getting an understanding of how all of the resources that you've accumulated, or the resources that you're getting from the divorce, are going to get you through to your goals and your aspirations in the future. What's important to get started is to prioritize or reprioritize your personal goals. You may or may not have had a plan with your ex, but now it's time to really sit down and think about what you're trying to accomplish and what you want to do. And reassessing your financial plan is very important. And again, I promise we'll talk a lot more about that at the end of this webinar when we talk about next steps and moving forward. So Diane, do you mind talking a little bit more about how to go about executing, sorry, my French is getting in the way, the settlement agreement?
Thanks, Cecile. Yeah, absolutely. And Cecile alluded to it, and part of what we find most satisfying about divorce financial planning is that we get to take that agreement, that's a series of paragraphs and guidance on what was decided on in the divorce, and actually executing on that. So we highly recommend that, especially based on the complexity of the agreement, that you read that over and maybe share it with your trusted professionals. The reason being is there are, first of all, timelines to consider. Not uncommon to find a property settlement agreement where one party is keeping the home. If there's a mortgage, it may be a requirement that that mortgage be refinanced within a certain amount of time. And even when it comes to dividing property, traditional investment or bank accounts, there's usually a window of time, 30 days, 60 days to get it done. So the first step is to understand the timelines and then get to understanding what you have to do to execute on that document. So we call that mapping. For instance, from joint accounts to your individual name will involve having an individual account, be it an individual bank account or brokerage account. Retitling assets from joint account to a single name is not complicated. Retirement accounts, however, require a little more documentation. Mostly that is to avoid taxes on any distributions that come from one party's IRA or 401k to another. So retirement accounts, IRAs anyway, only require the divorce decree and a distribution form for the party that's distributing IRA assets. A 401k, however, requires a separate legal document called a Qualified Domestic Relations Order, QDRO, as you see in our summary here. So 401ks require an additional document, but IRAs require the divorce decree. You can already see, and joint accounts don't require any of that. So you can already see that there are a lot of moving parts, even if you just had an IRA, a 401k, and a bank account. So the purpose of working through the agreement with someone that can support you in that is that you get all of this done in a timely manner. When it comes to the real estate, the primary home, maybe there's a second property, a rental property, there has to be a retitling, there has to be a new deed that is created, properly titled in one party's name, or there could be a scenario where you're keeping the home, owning it jointly for some period of time, but you're responsible for a new set of expenses. And we'll talk about that in a little bit. Cecile is going to talk a little bit more about the path forward, but not uncommon that we see joint investment or bank accounts, retirement accounts, and then real estate. Tangible properties a little bit easier. Maybe there's an agreeable date where one party's taking tangibles like furniture and artwork and that sort of thing out of the home. It's all been decided largely in the agreement, or it's decided that each party will receive 50% of tangible assets of equal value. That's not uncommon either. So the steps to dividing are very different. The timeline needs to be considered, and certainly extra documents like the decree or the Qualified Domestic Relations Order. One last thing I'll say about this before we move on is the timeline is important, but we also, Cecile and I have been finding more and more that it's been a challenge that there's something in the agreement that says, let me use an example. We have a Fidelity brokerage account and we're each going to get half of that. Or maybe that Fidelity brokerage account was only in one party's name. We seem to have a real lag in getting the other party to cooperate and get it done. And in the meantime, the reason it's important to do soonest is because there could be dividends that are accruing or interest payments that are to be divided. But if what's stated in the agreement is 50-50 as of a particular date, then all of this income that's accruing, potentially you're not benefiting from. So it's really critical to understand that and to keep track of activity that occurs after the agreement is signed to ensure that we've even had people where one party has sold stock that was supposed to be divided by two. So it's really critical to make sure that this happens in a timely manner and that you're staying on top of what activities occurred in the accounts since the agreement was signed.
Yeah, and perhaps making sure that you engage people who specialize in this, because we also have seen professional had good intentions, but didn't necessarily have the right information, because this does not happen every day, and all the required documentation is very specific. So don't be afraid to either engage people who specialize in it, or maybe question and make sure to ask questions or push back.
That's a great point, Cecile. Don't just rely on the other party to do what they're supposed to do either, or to even because if we're having this discussion, you can imagine we've had it lots of times over many years on many divorces, and often it's, even with the best of intent, someone just didn't know the steps necessary and either had a tricky tax situation to follow, or again, wasn't equitably divided as a result of something that happened between signatures and actual division.
Right.
The marital home is a big one. If it's not being sold, and even if it is, I think there's some things to consider there, and that is changing title, as I mentioned, if one party is keeping. We've had situations where our client is keeping the home and in many cases needed to qualify for a mortgage to refinance the existing mortgage that was in joint names. Very, very rare for a lender to let you just remove one party's name off of a mortgage. So therefore, when it comes to qualifying for a mortgage, there are rules. If you're not working and you're only receiving spousal support, then you have to receive support for at least 6 months. So be really careful in a property settlement agreement that says the mortgage has to be refinanced within 90 days, because you may not qualify for a mortgage in 90 days. It may take 6 months. Have the conversation with the lender and see what's required. That might require, because the agreement is binding, but we find that just, again, lack of knowledge, somebody needs to qualify and won't qualify until they have 6 months of support. So there just needs to be an addendum or something that everyone acknowledges it's going to happen, but it may not happen right away. In some cases, people are using other liquid assets they have to pay off the other party. So now you've got no mortgage on the home. The title needs to make sure that it represents who owns it. And then finally, maybe there's then less liquidity. So that becomes a different planning discussion as it relates to where is money going to come from to pay for the upkeep and maintenance of the home if largely the money's tied up in the home. So even if the plan wasn't to have a mortgage, that might be something that we'd discuss.
That's a great point. And with rates going higher, it is also possible that someone had a conversation with the lender a year ago when they were first considering a divorce, and now the divorce is final, but rates are dramatically higher and it may be a lot harder to qualify, or it may not necessarily be the best solution anymore to refinance the mortgage. As Diane said, maybe the best option going forward is just to pay it off. Or
yeah, exactly. And or, cash flow budget report was all built around what a potential new mortgage principal and interest would be. And it's changed because of rising interest rates. So, and so when not sold and divided, the last thing I want to say about that, sometimes not uncommon that for some period of years, a marital home might be jointly owned with your ex. If that's the case, you need to have really clear direction on who is paying for what. Maybe the principal and interest, maybe the mortgage payment is paid by one party and all the upkeep on the house by another. Maybe everything's split right down the middle, 50-50. But it is worth having a conversation, even a detailed email where you have something in writing that says, here's what I'm agreeing. If it's not already in the agreement, here's what I understand I'm paying for, here's what you're paying for, and so on.
Good advice.
This all from things we've seen go wrong, by the way. So this is advice because we're sharing it because we think it needs to be used in practice when you're getting through the division of the marital assets. Filing status, what you are on December 31st, you are for the year. So even if so we have cases where the divorce was only final recently, and we get to tax time, and then there's an argument or a discussion over what filing status each party is using, even so much so as one party already filed the taxes, married filing separate, and our client was expecting to do married filing jointly. So big surprises that come up there. But if in fact there was a refund due to the joint, to the married couple filing separately or jointly, there needs to be a note of this. There needs to be direction in the settlement agreement that says when the refund arrives, the party receiving it, whatever bank account is receiving it, then gets divided. If there was a liability that was joint, again, same thing. It needs to be addressed in the agreement. It used to be that child support, well, it's always been that child support is tax-free. Spousal support until 2019 was taxable to the recipient, and now that is tax-free. So something to keep in mind when you're working on your own cash flow is to understand that there'll be no tax implications of child support and spousal support. So after tax money goes obviously a lot further. There could have been tax benefits that carried all the way through 2021 or even 2022, based on where you are, like carry forward tax losses that you would benefit from having if you got your share. So we share that here when we talk about taxes to make sure that nothing's left on the table, that you have the ability to claim your share of carry forward tax losses if they exist, that there's been a decision about about filing status. If there's minor children who's claiming the kids and head of household. So tax filing is really important. If your divorce is not final but will be by the end of the year, that you should still address prior year's tax returns if they haven't been done or refunds haven't been paid. The one last thing about the house, we were talking about whether one party keeps it or it's sold. When you sell your primary residence, you get an exemption of $250,000 of gain. So if you paid $500,000 for a house many years ago that's now worth $1 million, if you were to sell it individually, you're going to have $250,000 of the gain that is exempt from taxes. And in my example, there'd be another $250,000 for which you'd have to pay capital gains tax on. If you own it jointly and you're selling it jointly and it was the joint marital home, then in that example, the entire $500,000 of growth would have been completely tax-free. So if you're not to the end of the agreement yet, and there is going to be a sale of the home, even if it's just we're waiting till next year to put it on the market, be sure that that's noted, that the house will be sold jointly, that you'll use two exemptions. In other words, getting $500,000 of gain without tax, no capital gain tax on the first 500 instead of the first 250. That's an exemption that we don't want to leave that on the table if the plan is to sell the house soon. Then we find we've got really what we call complex assets that need divided, such as stock options, restricted stock. Those are awards for one party or both. I mean, whoever's working in the corporation that's offering options or restricted stock based on your performance. So those types of performance awards, again, somewhat more complicated to divide in the marital division because the award is granted based on a certain amount of effort while married, but may not be liquid or vested until a point in the future. So one, that needs attention in the agreement, and two, will be treated as paycheck income when liquidated. So state and federal taxes, Social Security tax, et cetera. So all of that needs to be addressed. It's not uncommon in this area, the big corporations that are here, where employees of, a Northrop Grumman, a Facebook, an Amazon have built up a lot of stock in their company. And so that's what we're calling a concentrated stock position. It's a meaningful amount of one stock for which you're going to receive your share. Now, all of a sudden, you're not the employee. You don't have the same confidence, and you're left with a whole portfolio of one stock. And I'm sure if you've heard nothing else, that diversification and not all of your eggs in one basket. So dealing with a concentrated stock position is, I don't want to consider anything urgent, but it is one of those high priorities that we look at as we're working through an asset division with clients. And then finally, college savings accounts. Well, one party was the participant and the child is the beneficiary, and while it wasn't considered a marital asset, you certainly want to make sure that you are interested party if you were not the participant. That goes back to protecting yourself and what Cecile said earlier. She'll talk more about that. But to have a college savings account where one party is the participant and your child is the beneficiary, but you have no idea what activity is happening there, you feel at a minimum uninformed. So it's better to, at the point of the agreement, to say, if it's not been said, that you will be an interested party in accounts that are for the benefit of the children.
Mm-hmm.
I mentioned it in the first slide, and that is corporate benefits like 401ks and pensions. They have a unique division, a process that involves another legal document. Rarely is deferred compensation. I've not ever seen where deferred compensation could be divided, but when the compensation is received in the future, that can be divided, or we use it as an offset. One party keeps their deferred comp and the other party gets something instead of deferred comp, in lieu of the deferred comp. Government and military benefits are the same way. They require special documentation. As I said, the IRAs and a Roth IRA, they just require the divorce decree, and the IRA owner signs a document that says X amount, 50% or a certain dollar amount is going to be paid out to the other party. And then finally, Social Security eligibility. There is no requirement in order to collect your spousal share of your spouse's Social Security. You don't need your spouse to approve that, to be agreeable to that. You're just going to go to the Social Security Administration at the time you're ready to collect to determine what's in your best interest, your own benefit or 50% of your spouse's benefit. So, and then there are also consequences if you remarry, and you may be foregoing a benefit from your former spouse. So as Cecile always says, check with your financial advisor before you marry. And there's some truth to that because there are things that we do sort of run through a checklist of things that need to be considered if you're going to be remarrying. And then there are some Social Security benefits that are not a full benefit because of a certain type of pension you got from the federal government. So that's rare, but there are the former retirement benefits, an old plan from the federal government. Some government employees receive that instead of Social Security, or there's an offset. So that's what we're referring to there. Every situation is so unique. It really, your own situation is going to be, even if you were working with the same amount of money as another person divorcing, how it all shakes out, how much that's in retirement in your home, in concentrated stock or deferred comp, all of those variables make up your own unique settlement agreement. And so execution of that's going to look very different for each person.
Absolutely. And that, you were mentioning the consequences of remarrying as it relates to Social Security, but it's probably worth noting that it could have consequences to your support too, if you're awarded support.
Yeah, great point.
So it's, we always tell people, we hope that you find love again and you're happy, but definitely consider the financial consequences of that. Well, thank you, Diane.
Sure.
So now so we've talked about how to execute the agreement. Now we're going to talk a little bit about protection and protecting your property settlement agreement. Diane already mentioned remaining an interested party on college savings accounts just to make sure that the money is going where it's intended to. Again, we've seen examples, sadly, of people using the funds for the wrong reason. So you definitely want to, if you're not the participant, make sure you're informed and you can monitor that account. Life insurance. So usually if you're going to be receiving support, we recommend that you have life insurance to protect that support. What would happen to your support if your ex were to pass? So if you already had a life insurance in place, usually you're going to keep that life insurance in place on your ex, and you're going to remain the beneficiary as long as your support is in place. So again, if your ex is the owner of that policy, you at a minimum want to make sure that you're an interested party and make sure that those premiums are getting paid and that nobody's borrowing against the policy and hurting the benefits and so on and so forth. If you didn't already have life insurance in place, then you'd probably sooner rather than later, if not already done, definitely make sure you take out that policy on your ex to protect your support.
I just want to mention you can't force it, but that's why you want to make sure if for any reason the agreement was executed without and things are amicable enough, it's worth asking it, knowing that you'll pay for it. It'll be your expense, but you'll willingly do it to protect your support.
And that's a great point. Yeah, I know it's an expense, but it's usually better if you just pay for the premium, because then you're sure that that premium is getting paid and the insurance policies remaining in force. So that's a great point. And sometimes we get the question of how much insurance should I get? It is usually a present value calculation of your support payments. So we can definitely help with calculating this, or your financial advisor can definitely help with that calculation and the amount of insurance that's required. With regards to remaining an interested party, again, Diane mentioned earlier that sometimes people will keep the marital home jointly for a number of reasons. So if you're not staying in the home and your spouse is staying in the home, but you're staying on the mortgage, again, just make sure that the mortgage gets paid and you're an interested party there. Because you wouldn't want it to, if your name is associated to any debt, you definitely want to make sure that those minimum payments or those payments are being made and that's not hurting your credit. Another instance where you definitely want to remain engaged is if your ex-spouse was a business owner and your support is derived from that business income. You're going to need some proof of that business income and making sure, usually you'd probably want a CPA involved and making sure that they're reporting their income the right way, not trying to all of a sudden have a loss and not have any income and so on and so forth. So this may be a situation where you need to engage an accountant or a CPA. We talked about life insurance and support, beneficiary changes, absolutely update your beneficiary designations. So that's going to apply to your retirement accounts. Usually you'd probably have your ex, or you likely had your ex as your primary beneficiary. You're going to want to update this and name whoever you want to be your new beneficiary. It's going to apply to your life insurance policies too, if you have any. With regards to non-retirement accounts or accounts that don't have beneficiaries, like your investment accounts, or mutual fund accounts, things like that, that's going to require you to update your will and your estate planning documents. So definitely, I hate to add to your expenses right now because you probably already had a few attorney bills, but this one is definitely necessary and good to do sooner rather than later. So highly encourage you to meet with an estate attorney and review your trust if you have a trust in place, your will, your medical directives, and your financial powers. And, people sometimes drag their feet on doing this because they hesitate as to who they should choose as their financial power, medical power, trustee, executor. And all I'll say is it doesn't necessarily have to be the same person for medical powers and financial powers. Sometimes you have that relative who's very caring and good with medical issues, but not necessarily the person who's good with financial issues. So try to think about, who in your family is good with, or out of your friend group is good with finances, who's good with medical. And if you can't think of anybody, sometimes there are corporate trustees who can step in and take care of this. So definitely talk to your attorney, talk to your financial advisor about this, but don't delay just because you can't choose someone. Okay, what about portable benefits? So oftentimes we'll see, oftentimes couple are usually on one plan. So if in your case, you used to be, your health insurance benefits were on your ex's plan, you will have the option of still being under the same plan essentially through COBRA. And COBRA in the instance of a divorce can last up to 36 months. So you do have some time to make a decision around your healthcare benefit, but know that COBRA is not always the cheapest way to go. So again, it's probably a good thing right now to go speak with an insurance specialist and see if you can get either a better coverage or equivalent coverage at a cheaper price. I actually had an example of someone's COBRA coverage that went away before the time limit because their ex's company went under. So also, think about that too. We don't see this very often, but sometimes corporations will offer long-term care benefits. So if you had a long-term care benefit through your ex's employer, this is definitely very valuable too. And you may want to inquire about this and see whether that policy can be portable and could you make premium payments on your own. Protecting your credit is incredibly important in a divorce, and sometimes we see people hurting their credits not intentionally, but just through bills being missed or not being in that interested party. So definitely make sure, if anything, that minimum payments are being made on all credit cards that your name is being tied to. Once a divorce, it's going to be very hard during a divorce to remove your name from any debt. Until the divorce is final, you're going to stay on all of those credit cards, that mortgage, etc. So make sure payments are being made. That can always be sorted post-divorce, but you definitely want to protect your credit and make sure that you don't forget about any bills going unpaid. Especially if you're going to be refinancing the mortgage or if you're planning on taking out a loan anytime soon. Credit is very important. We actually, I forgot that considerations when remarrying was on here. So we already talked about it, but just know that if you're going to remarry while you're collecting support or Social Security, that could potentially stop your support. So it depends on where you're located, but just know that if you start cohabitating with someone, there's a chance that your support could stop. So that could potentially be a big financial impact. What happens if there's lack of compliance and someone does not is not agreeable and does not implement what's in the property settlement agreement? Well, the property settlement agreement is a binding legal document. There are some things that can be modified, but very few things can be modified. So support sometimes can be modified, but it doesn't require just someone saying, hey, I changed my mind. I think I'm paying you too much. No, it requires changes in circumstances. So if your ex is not cooperating, dragging their feet, not paying you or refusing to sign documents, go back to your attorney. And of course, be mindful, if we're talking about dividing a $500 account, it might be more expensive to go back to your attorney. But if we're talking about meaningful amount of money, it's definitely worth going back to your attorney sooner rather than later. Diane was talking about timeline earlier. The sooner you address things, the cheaper it gets, because if you let things fester and, it just gets worse. The problem just compounds upon itself. So definitely, if someone is not doing what they're supposed to do, go back to your attorney and make sure that things get done.
Cecile, one last comment on that, and that seeing more and more lack of compliance, I would just say it's okay to get people in the middle of it all. Like we find ourselves often speaking with the family's financial advisor to get things divided. And so you don't have to be the bad guy. You don't even, you can collaborate with professionals and get them to do the work, because time is of the most importance in terms of getting things into your own name, but you don't have to go it alone.
That's a great point. Yes, you don't even have to communicate with your ex. Let your attorney do that. Let us do that. Let your professionals do that. That's a great point, that sometimes people don't drag their feet and don't necessarily want to go back to their ex because they don't want to communicate with them. But you can certainly get your support team to go ahead and do that for you. Okay, let's talk about moving forward now. We talked about how to implement everything that you've agreed to, but how do we go about moving on and making sure that you're financially secure going forward? So I started with saying you definitely want to reassess your priorities and the validity of your current plan. Very likely you're going to have new sets of goals and objectives and new priorities. So it's definitely well worth the time to sit down and think about what's important to you. What do you want to do? Where do you want to live? And so on and so forth. And with this, you're going to need to reevaluate the risks that you're taking and your objectives. Very often, once we start dividing assets post-divorce, the assets are not necessarily aligned with our clients' goals and priorities. So it's not because you and your spouse had agreed on a portfolio and it matched your goals then that it still matches now. So that's why this exercise is so important. You first have to decide where you want to go, and then your plan will follow and your investments will follow too. So the very first step is to take a financial snapshot, getting a good understanding of what your cash flow is. What is your new income post-divorce? If you're receiving support, then take this into consideration. If you're paying support, then that's definitely an expense to you. So you do want to know where the money is coming from and where your expenses are going to. So you probably have current expenses, but post-divorce, you may have new expenses as well. You may have a new rental, or you may have a new insurance policy. You may be paying for life insurance premiums, and so on and so forth. So it's definitely not a waste of time to write it down, or have a good software that tracks all this for you. And once you get a good understanding of your cash flow, you also want to get a good understanding of your balance sheet. So definitely know where your assets are and where they're coming from, and what your liabilities are. As far as assets, we were talking about timeline. What's important to remember too is it's a little bit of a process where you're going to be getting some assets now, but some assets you may not have under your name for a while. That's a case of a 401k. If you're dividing your ex's 401k, it may take up to a year to have a quadro in place. So it requires some patience, but it also requires some organization and checking on that and making sure that, while it's expected that it's going to take a while, you also want to nudge things along and make sure that somebody didn't forget about it in the process. And, that the other financial institution didn't reject the paperwork. And so just know that it's going to take a while to put your assets on that balance sheet and making sure that you receive everything. And sometimes, again, Diane said it earlier, there may be assets that you may not get right away, and it may take years for you to get them. Like a deferred comp may come in the form of a lump sum when your ex retires. Or we had an example of an illiquid asset that couldn't be divided right away, but was divided later. So try to keep track of this. And again, if that's not your forte, defer to your financial advisor and have them help you with that process. We put ability to earn down there because Diane and I like to think abundantly. So sometimes when people start thinking about, improving their cash flow, they often think about cutting expenses. We like to think about ways to add to the plus side too. So for example, if you had been staying home for a while to raise the children, or maybe, your ex was making more than you and you didn't need to earn as much, maybe now is a good time to think about what you want to do and focus on your own career. So is there a way for you to not only cut expenses, but maybe earn a little bit more? Divorce is expensive, and usually it's usually a hard time because you go from 1 to 2 income to having two different people run 2 households. So by definition, a divorce is more expensive. So it's probably your cash flow is going to be a little bit tighter likely than it was in the past for a while. So it doesn't hurt to think outside the box and think about pluses and minus the 2 sides of the equation. Okay, so once you get a good understanding of where you are, you're going to want to develop your goals. And so there are some steps of creating your own financial plan, but what we'll say in divorce is you have to plan in baby steps. You went through a huge change, and likely change is still going to happen. It's probably very hard for you to know today. It's very hard to plan for the next 30 years after such a big change. So don't try to plan in more than 5-year increments at the beginning. Focus on liquidity. Liquidity is everything. It'll afford you to have flexibility and do things in the short term. Cash flow is so important too, because if your expenses are more than your income, then it's going to be very stressful. So liquidity and cash flow are so important to focus on. And then I mentioned it earlier, but depending on what your plan is, you may need to rebalance your investments. So it's going to be, again, worth sitting down and looking at your portfolio and getting a good understanding of, am I invested the way I should be? We just spoke to an advisor who was talking about buckets, and I think in this case, it makes sense. You want to have your safe bucket for your upcoming expenses. If you're going to be buying a car or, buying a house, and you want to make sure that you have that safe pot of money for that down payment. But then you're going to want to have your bucket for intermediate term goals, and then your bucket for long-term goals. As much as you need your safe money, you also can't afford to be too conservative. You definitely want that long-term money to be growth oriented and be productive. So it's a balance. And again, if you don't feel comfortable doing it yourself, defer to a professional there. There are certainly opportunities to simplify things. In divorce, we often see a lot of accounts moving, spouses having different retirement accounts and maybe different registrations, simple IRA, SEP IRA, 401k, TSP, but there is an opportunity to consolidate this, because if things are a little bit simpler, it may be a little bit easier to getting a good understanding of what you have. So as far as protecting your plan and talking a little bit about insurance for a minute, we talked about healthcare. Even if you're covered through COBRA right now, definitely go back and review your policies. Depending on your age and your health, you may want to consider getting a long-term care insurance or a disability policy. If you have children, you may or may not need a life insurance policy. So, you're definitely going to, as much as you're going to have to review your portfolio, you're also going to need to review your risk management portfolio. And you're also going to want to look at your property casualty policies. So, your homeowner's insurance or your renter's insurance, if you're renting, your auto, definitely look at your umbrella liability coverage. If you have teen drivers, who's going to be covering the teen drivers? Is it yours? It's going to be your ex, because that could be very expensive, and Diane can share a little bit more with you if you need to. But it can be very, very, very expensive. If you had a safe driver discount in the past, it's also, these are those valuable, but not necessarily, they're not necessarily considered assets, but you definitely may want to look into this and call your insurance company and see if you can benefit from your safe driver discount, or was the policy under your ex as the main policy holder? You may not be able to benefit from it then, but it's worth the questions. Another one is airline miles too. That can be pretty valuable.
Cecile, I just had a case where the client has a home. Neither party was living in it. Actually, it was vacant. And the client had to get something called vacant home insurance, because the risks are different if no one's in the home, right? Maybe not fire or flood, maybe it's vandalism or other things. I don't know. It's just a completely different type of thing. So there could be something where there's no decision, or the house will be sold, but both parties have already gone, waiting on the house for sale. So all of that worth talking to a property and casualty agent about. You know, your current agent just saying, hey, nobody's in the home. What type of insurance can we use for a vacant property?
Mm-hmm. Yeah, that's a great point. I never heard of that, actually.
Yeah, I hadn't until it came up.
Mm-hmm. Yep. So, and we can here too, we can recommend really good professionals if needed. You know, if you have a good agent you feel comfortable with, go back to them. But if you need someone new, we're happy to recommend someone. Some miscellaneous items. Once you're done with your divorce, you may need to update your mailing address if you're not staying in the marital home. Definitely change your passwords. That one is a very important one. You know, we live in such a digital world that you wouldn't want your ex to have access to your bank account and things like that. So change your passwords. It's not a bad idea to have a password management system for that. Change your locks if you're staying in a marital home. If you have children, you may need to update HIPAA forms with school. And then if you're going through a name change, that's going to apply to your driver's license, social security, some of the school forms. So all of this is administrative, but necessary to get done. So as we summarize a lot of what we talked about, I think that step number one is build your team, find the help that you need depending on what you're comfortable with and what you're not comfortable with, knowing that sometimes you don't even know what you don't know. So don't be afraid to ask questions. Take ownership. You know, it can be overwhelming if you haven't been the person handling the finances. It can even be overwhelming if you have been the person handling the finances. This is all pretty new and it's a lot of moving pieces. So don't be afraid of taking ownership and again, asking questions. Take action, you know, not doing anything, you know, if your ex is not cooperating or, you know, doing nothing is not the best course of action. And then even once you sit down and go over your plan and think about your financial future, you're definitely going to want to reevaluate that periodically. You know, the only constant in life seems to be change. So I'm not telling you not to do it. Definitely sit down and go through that plan. But remember that periodically you're going to want to know, you're going to want to make changes based on your life changing and your circumstances changing. And don't forget to celebrate successes. You know, don't be hard on yourself. This is going to be complicated, but you definitely celebrate along the way. So the last slide here about building your team, we get a lot of questions here about choosing a financial advisor. You know, advisors can come in all shapes and sizes. It's very, very hard to choose. But, you know, I think it's very important to get unbiased advice. And in order to get that, it's helpful to understand your advisor's credentials. You know, some credentials like the CFP certifications will basically, I hate to use the term guarantee, but it'll indicate that your advisor has to be acting in your best interest as a fiduciary and therefore be unbiased. Compensation structure is very important too. So when choosing an advisor, ask those questions. How are you compensated? You know, are your interests aligned with mine, basically? And I said it before too, definitely align the expertise of your advisor with your needs, even regardless of geography. It's so important. So, you know, post-divorce, it's probably good for you to choose an advisor who's experienced in that field because it's very complicated. And then as you grow your team, you may want to have a CPA, bookkeeper, estate attorney, mortgage lender, etc. So feel free to use this as a resource. That's why we're here. That's why we started Done with Divorce. We do want to help the community, so don't hesitate. And I'll just leave you with this quote from Lao Tzu, that new beginnings are often disguised as painful endings. So hope this was helpful. And if you have any questions, let us know.
Great. Thank you so much, Diane, Cecile, for all your wonderful information today.
Of course.
Thank you, Elise.